Very inspiring, is it not? I always find myself, when I was listening to Pat's talk, we've been through a lot, haven't we? A few panics here and there, Great Depression, Great Recession, other recessions. I'm sure there are other events in U.S. history, and still we manage to move forward. I think that's very inspiring. So yesterday, we were talking a little bit more about the nuts and the bolts. We talked about mentoring, we talked about pitches, we talked about things that would be very helpful to you as an entrepreneur with developing your skill sets. This is a very special session, talking about what's the end game here? What's the end game for everyone? We use that term loosely, maybe exit strategies. So we have a very distinguished panel, and I'm going to stop talking and start introducing. It's my pleasure to introduce Dr. Judith Giordan. She is a partner at ecosVC, a venture developer and funder, a co-founder of the Chemical Angel Network, and senior advisor to the National Collegiate Inventors and Innovators Alliance. Judy is a serial entrepreneur in her own right, formerly acting as Vice President of Global Corporate Director of R&D at International Flavors and Fragrances, Vice President of Worldwide R&D for Pepsi, the Pepsi-Cola Company, and Vice President of R&D for the Henkel Corporation. Judy's going to moderate our panel on exit strategies, finding the end game. Please join me in welcoming Dr. Judith Giordan. Judy, the floor is yours.
Thank you. Gentlemen, we're going to ask our panelists, who are really the brains of this outfit. That does not imply that I'm the beauty of it. It just implies that they're the brains of it, to come up on stage. And while they're doing that, I'm going to thank Dr. Conflone, because it could not have been a better tee-up for what we're going to talk about. And I'd like to bring up two specific points. First of all, is it in any order you'd like, gentlemen? Doesn't matter. Oh, here, I'll take mine. Steve has been around for a while in the last day or two, gentlemen, so he's got his own tent. He carries it with him somewhere. Two things. First of all, as these gentlemen will share, there is dollar. There are dollars. There is money out there for innovation. There really is. But the bogey to get it, the opportunity to describe your need for it, has really risen as well. The bar isn't where it used to be. It's much higher. The second most important point I'd like to also emphasize is we are in an incredible transition time. Remember what Dr. Conflone's data showed. We're moving from a time where most big corporations did the majority of the disruptive innovation to a time where they're looking for open innovation and sourcing from smaller companies. That implies amazing disruption. When large corporations like Procter & Gamble or Pepsi want to innovate and come out with a product, we've got the full suite of skill sets to do it in that company. Well, when you're shifting to a disruption of science that comes from smaller companies, which may not have that full complement of skill sets, what you really need to think about is how you're going to have an exit and a financing that brings some of those skill sets together in a way that you wouldn't have just as a startup company. And that's really, really, very needed. So let me start. I'm going to give you some background data. I'd like to welcome our three very distinguished panelists. I will give you their bios in detail momentarily. Scott Lockledge, Ed Greer, and Steve Flaim. They represent three different spectra of dilutive funding, equity-based funding. Scott from a venture firm, Ed from corporate venturing, and you'll see that in a minute, corporate technology scouting. I don't want to get mad at me. And Steve is wearing many hats in this meeting, but he's wearing his angel investor hat for this particular one, okay? And I'll introduce them in great detail in a minute. But we put a few slides together here to give you some background. First of all, bottom line, we all agree that raising dollars is a contact sport. And sometimes, for the wonderful world of scientists we are made fun of, and we don't always look up at somebody else, we need to, because this is a contact sport, which means four major things. You have to know who you're approaching and why. They're very different people. They have very different views of what the type of funding is you can get from them and what they're looking for. You have to know who you are and what you're providing. You have to figure out how big you aim to grow and how you expect to exit, because all of that links to the type of structure and funding, and it all comes down to you showing yourself to be credible. All dollars are not equal. You can get sometimes big checks and you hope people go away. But if what you really need is contacts to do things, be sure it's really dollars you need when you really might have contacts. So remember some basic math. Never take more money than you need, but never, never, never take less money so that, as Mike Leffenfeld said yesterday, oh my God, you know, like I got 10 million in the bank, but I know I'm going to need 30, so I'm on another raise. So don't take too little either and skimp yourself down and really always be out there trying to raise, because that can be very, very disruptive in its own way and you can tank relatively quickly. And remember one thing, 100% of zero is zero. So if you don't want to give away equity and you don't want to get anything and you just want to get cheap money, you know what? You're still going to have 100%. Good for you. Times zero is still zero. You know, the math is this. It's not an infinity factor. It's a zero factor here. The next thing we want to make sure that you guys, everybody in this audience here, is what makes you credible. When you pitch to an investor, I don't care about you. You have to care about me. I've got the money. They've got the money. So what makes you credible to them? It's doing a SWOT analysis in a good way. You've heard of SWOT, strength, weakness, opportunity, threat. I think it's a ridiculous analysis because most people do it from their own lens. You must do it from the lens of the market. They're your market. And how does your proposition align with the investor's goal? Which means you have to do your homework. We are focusing, I said, on angel, venture, and corporations. There's other types of functions of dilutive to founders. That includes equity partners, debts and convertible notes. That means if you don't pay the debt off, it converts to equity. And there's, of course, the entire non-dilutive, and you heard about I-Corps. We're not talking about that today. We're talking about how you're going to love us. You need us. And if you want to get our money, you also get, in some cases, a lot of us coming along, depending upon what it's going to be. There's an investment continuum, we will argue. And I will hear back from my colleagues. They all said they liked the slides, so we all kind of saw the slides and worked on them together. But basically, correct me if I'm wrong, Scott will correct us all, VCs really want to see something, some will do it early stage, but usually they want to see a little more traction. The word is traction, right? RIP, we all know that. Angel investing, we can be all over the map. Industry wants to see a pull through to why there's a value, but we will hear Ed tell us the truth about that, rather than just tossing money around. Industry tried that for a while. I was involved with that, Next Gen 3 and everything else, and we all stopped doing that. And then there's the plethora of other pieces that fit in. If you don't understand the map, you might be looking at the wrong people for the wrong time. Last but not least, we want to argue that there's kind of a three-dimensional graph here. Depending upon the money, it has to do with how much they're going to help you, how much it has to align with their mission, and what the return is. And basically, grants are all about mission and impact, sometimes return. Royalty capital, convertible debt's all about you better pay the debt back. Venture and angel are all about return and mission and impact. So don't go, if you're a chemical person, to an IT firm, we're not going to fund you, or knowing where you're supposed to be. And so the basic idea is understanding where you are on this continuum and the nature of the funding you want. Do you want help? Do you want money and go away? What are you looking for is a big part of you figuring out. Before I introduce our esteemed panel, you're going to introduce yourselves to us first. So we agreed we were going to ask them some demographics. So here we go. And guys, if I don't ask all the demographics you want, just say, wait a minute, ask another one. We're all in this together. How many of you out there are, that you would say, corporate scientists currently employed in a company? Big corporate. Not small startup, big corporate. Ooh, small number. How many are former big corporate? Okay, all right, this is good. How many of you are students or graduate students or postdocs starting a company? Awesome. Oh, there's a young lady in the back. I saw you put your hand up. How delightful to see you. This is wonderful. That's why we're all here. How many of you were involved with one of the ACS entrepreneurship initiatives, the Resource Center or something like that, and that's why you're here? Brilliant. This is absolutely fantastic. How many of you are academics? So how many of you who are academics are also involved in entrepreneurship? Okay, so that's kind of why you're here. That's great. What else, guys?
I'm good. That's good.
That was good?
Yeah.
That helps? All right, fine.
Yep.
Let me introduce our panel so you know who it is. We know who you are. How many, let me ask a different question. Let me ask one more question. How many of you See yourselves as entrepreneurs today in a service-based business as you're starting up. So consultants are a service-based business, right? A lot of that, different kind of business model and how many of you are entrepreneurs, my words, in a product-based business? So you're offering as a product. Fantastic. Okay, so that kind of helps us on what their offerings are. Great. Please let me introduce our esteemed panel. I'll start with Steve Flaim, who really needs no introduction. You've heard about him before. He holds a doctorate in human physiology and pharmacology from University of California, Davis. He's been a faculty member. He's been a entrepreneur. He is, in this case, we're here to hear about his amazing abilities as chairman of the board of governors for Tech Coast Angels and past president of the San Diego network of Tech Coast Angels. Please remember that Tech Coast Angels is, I think, the largest angel network in the United States. Is that not true? And especially focused on technology. So, as is wonderful in California, you throw a rock and you'll hit something that has to do with a startup. As is bad in California is the density is very high, and trying to swim above all of that debris can be really hard, okay? Better in Philadelphia, negative, you don't have as much money around, but positive is that you can also. So there's a negative and positive. Don't feel bad if you don't have Tech Coast Angels right there, because you can. You have a connection right now. Torture him regularly. I'd like to introduce Dr. Scott Lockledge. Scott is a VC. He's a PhD, he's a scientist and an entrepreneur. He's been the CEO and co-founder of 2 VC-funded nanotech startups, so he knows of which he speaks and in which he funds. He's the chairman, he chairs the advisory board of the National Science Foundation Center for Nanostructured Electronic Materials. He's on a number of committees, including Science and Engineering Fellow in the Executive Office of the President. He's been with OSTP, so he understands the regulatory government side as well as spending money on other pieces. And he also holds a PhD in inorganic chemistry from the University of Illinois at Urbana-Champaign and a BS from Penn State. So he's sort of I don't know, he's probably equally mad at the Punxsutawney Phil these days, but we'll leave that alone. And I'd like to introduce Dr. Ed Greer. Ed is a PhD chemist. He is now Dow, but you're formerly Roman Haas, so local Philly. This is good things. He's the member of the Scouting and Exploration Network and Dow's Ventures and Business Development Group. He's responsible for finding and evaluating technologies that complement, notice his words, these are his words, complement Dow's robust research and development pipeline. So it's not, we're just going to toss money, so that means you better do your homework to understand what Dow's pipeline is. If not, approaching him might be a faux pas. So it's doing your homework. He's got a bachelor's degree in chemistry with honors from the University of North Carolina, Chapel Hill, PhD in analytical chemistry from University of Wisconsin-Madison, and has done local Philly things at Wharton. He also, I'm very pleased, as a former member of the board of directors of the IRI 1,000 years ago, he was co-chair for IRI on corporate venturing. So that's wonderful. Here's our format. It's really simple. It's all about you. We're going to do a lightning round of questions, 2 questions we've all crafted together that they're each going to take about 2 minutes to answer 2 questions, and then we're opening it up for you for the rest of the entire time to ask whatever questions you want. So start thinking about your questions now, please. That or it'll just be very quiet up here. Oh, and that's me. Oh, and the only thing I want to proselytize for is the Chemical Angels Network. We are up, we are running, we are funding, we need angels, you just need to be a qualified angel. We're looking for people to become angels, and we're funding companies right now. So if you've got a company and want to apply, www.chemicalangels.com. And I've already put in a plug for Tech Coast Angels, and you'll attack these other 2 on your own. Question number 1. Steve, I'd like to start with you, please. From your lens as an angel investor, what do you think angel investors are looking for as the top 3, 4, whatever attributes for potential investment? Meaning, what kind of a story can I come to you that would say, I am now too compelling for you to pass up?
Okay, so I'm going to speak from the standpoint of Tech Coast Angels. TCA, of course, is agnostic about the kind of business, the kind of technology. We always say sometimes it's no tech, low tech, and high tech. So we tend to think about other things in terms of the investments that we like to make. So from my perspective, the first thing I do is I assess the entrepreneur, him or herself. I want to see how they communicate. I want to see whether they have passion and enthusiasm for whatever their business is that they plan on presenting to us. So that to me is the most important thing. I invest in people, not in technology. Secondly, I tend to focus on healthcare issues. So personally, I will not invest in social media and in software and so forth unless it's healthcare related. So I understand the healthcare sector pretty well, and so I'm going to focus on the healthcare technologies, and I'll understand those. If I can understand what the entrepreneur is trying to do, that makes it more attractive for me. And then the third thing, which I think is extremely important, is the deal. Obviously, I need to know that there's a market and there's a pull for the market, and I understand all of that, but what is the deal? So for angels in general have a couple of requirements, and I mentioned a little bit of this yesterday. Angels usually invest, we invest our own money, so we pull our own checkbook out, and we write a check, and we give it to the entrepreneur, but we need to know how much stock we're going to get for our check, which means that we need to know the valuation of the company, and the company for an angel investment is usually not going to be valued more than about $3 or $4 million. If you think your company is worth more than that, then you need to be talking to the venture folks, because that is beyond the angel investing sector. So when we invest in a company at Tech Coast Angels as a group, we tend to put in somewhere between $200,000 and $1.5 million, and the company pre-money value is going to be somewhere not more than about $3 or $4 million. So if you do the math, at the end of the day, when the deal is done, Tech Coast Angels as an aggregate group of people are going to own about 20 to 25% of your company. So you have to be comfortable with that kind of a deal if you want to get angel investors involved in your company. So I think those are the three most important things. I'll just go back and say the most important thing for me is the entrepreneur. Secondly, the technology needs to be healthcare. And thirdly, the deal has to conform to the kind of sector that we tend to invest in as angels. Does that answer your question?
That is perfect. Let me ask you one other question on that low end. I got this from some of the younger people in the audience. If they only thought they needed 80 or 100,000, let's say they did the math right, you should still come to an angel group, would you say? I mean, that's not too low for us.
Right. So at TCA, we have the traditional angel deal, which I just described. And then we have an earlier stage deal that we do occasionally, and it depends on a number of issues, and that's what we call a seed track deal. And seed track deals usually require less money, maybe $50,000, $80,000, $100,000, and usually the entrepreneur, the company they don't have their whole team put together yet. They need some significant input. And so maybe they need a CEO, or they need somebody who really understands the financial side of things. And so one of the members that actually puts his or her money into the deal will actually participate with the company and become part of the company. So that kind of situation occurs, and there's a section of our membership that really like to sort of get involved with the entrepreneur and have money in the game and really help in a hands-on kind of way. So
that's sort of that help axis that I put in my little three-dimensional graph.
Exactly.
Angels, we like to get our hands dirty. Thank you. That's great. Ed, I'm going to move on to, boy, you guys sat yourself in exactly the order of this. How amazing. This was a total accident. From the lens of a corporate technology scout, what do you see as the top three attributes for a potential investment? What would make it compelling for a Dow, or if you don't mind, I know you can't speak for a DuPont, but a large company kind of view? Too compelling to pass by.
Okay. So I'll speak from the point of view of a strategic investor, which I'll just take a second to contrast with with an institutional investor, such as a venture capital firm. And you can kick me under the table if you don't like the answer. I have very tough shins. An institutional investor is typically looking for a financially attractive exit. So you want to make money in a transaction. In general, a strategic investor is looking in some capacity to participate in a potentially attractive business. So that could be an exit in which we would buy the company. But there's certainly other strategic investors that make investments for different reasons. For example, IBM has long been known for investing in software because it stimulates an ecosystem into which they can sell hardware and services. So I think you need to look at the source of the money and understand what the ultimate attractive outcome is for that particular type of investor, because it may or may not align with your interests. Okay, so now on to my 3 things in my remaining 15 seconds. So the first
I am
case,
such a louse.
the first case is tautological. So we're a strategic investor. You have to match our strategy. So you wouldn't come to Dow with a bone cement because we don't do things that stay in the body. You know, cool roofing materials save lives, but Johnson & Johnson would probably be uninterested in those. So find out what the strategy is of your potential investor and make sure you align with that. The second thing I think was very nicely outlined by Pat earlier, which is we're looking for disruptive innovations. And so we're looking for a sustainable and compelling competitive advantage. And that's not buzzwords, so I'll break it down for you just to make it clear. You have to be able to provide a disruptive innovation that brings value to a customer that they're willing to pay for. And then we have to believe that not only will the duration of that value provided be long enough to pay back our investment, but to make this into an attractive business going forward that we'd like to participate in. So all of those things have to be met. But generally, whereas, for example, Steve mentioned he was looking for an entrepreneur to invest in, we are really looking for the technology as our second screen. And then the third screen, again, because we provide different services than would be provided by a venture capital firm, we ask you, what's the fit? So what is it that you don't have that working with Dow, because we intend to bring more than just money, we intend to bring everything we got to the table, manufacturing, R&D, marketing, all of that stuff would be available to you. So what do you need, and why would we be the best fit for you? Why would Dow be the chemical company you would want to work with to bring this to market faster and better than anyone else?
That's fantastic. So you can see the point of we're in a transition time about where does disruptive innovation happen. You've got the infrastructure to make it happen. You've got the pull and the desire and the market focus to make it happen. You might have the disruptive innovation, but you got to align it. This is really key. It's not that disruptive innovation is not happening. It's happening in a different way, and we're all learning how to adapt. It's very exciting. It's just for some of us old war horses, we got to learn a lot of new tricks. Last but absolutely not least, how many of you out there who are product-oriented have always said your goal is, I want a VC to fund me? This is the most shocking thing I've ever seen, Scott. Generally, when I ask that, every flipping hands in the audience goes, do hands. And they're about, oh my gosh, well, sorry, I didn't mean to make you feel bad there. So let's just go quickly. So what are the top 3 attributes that they really want to share with you to say that you really want to invest in?
I can see if you go to Silicon Valley, every hand in the room goes up.
Oh, well.
Okay, so the institutional investor, and I should start out by saying, all of the things that Steve and Ed are talking about are all important, the team and so on. But let me talk about 3 specific things. First of all, for an institutional investor like a VC, you have to have an addressable market which is at least $100 million. And what I mean by that is that whatever technology you're developing has to have the potential to go through a growth curve where you could address a $100 million market. So you don't have to have sales of $100 million, but the size of the market has to be at least that big, preferably $300 to $500 million. And the reason for that simply is just growth. So we're looking. The responsibility of an institutional investor is that you're getting a chunk of money from somebody, and you're investing it, and you want the return. And it's really just simply about that. It's about the money. It's not about the company. It's not about the vision. It's about the money. And so we're looking at ways in which we can generate that return. And if the growth potential is not there, there's not a good fit. So that's one. And by the way, not all good companies or great companies are going to fit that criteria, but that's what we're looking for. We're also looking for a company where you've minimized the market risk, and by that I mean you've actually found customers who are willing to pay for the product that you're developing, product or service. We would typically be looking for a company that's got at least $1 to $3 million in sales into a market where rapid growth is possible, if not actually already underway. And then the third one is we're looking for companies that align with our skills. Anybody can bring money, and money is money. But it's really about what we can do with that technology. And let me give you a quick example. There was a company called Mobeam that was kicking around Silicon Valley for a couple of years. And Mobeam is a digital couponing company. You pull out your smartphone, you take a Mobeam app, you run it in front of the scanner at a grocery store, and it automatically uploads the coupons. So one thing that Silicon Valley doesn't do particularly well, is consumer products. Steve Jobs and Apple being the exception, obviously. But nobody really picked that up. And so when we saw that, a company, and in particular one of my partners in venture, Ben DuPont, is part of the DuPont family, looked at that and said, hey, we know something about consumer products. Let's go to Procter & Gamble, a bunch of other consumer product companies, and see what they think about this. So, we made the investment, took that company to, some big consumer product companies. Procter & Gamble said, hey, this is great. We really like this because it allows us to control the couponing. We don't have to go via Google and the internet. So they signed on, and we built a consortium of companies that really liked that. Once we had that, then the company went to Samsung, actually Apple and Samsung said, hey, there's going to be a demand for this. And we're going to put this into our phones. So last week when Samsung announced their Galaxy 4 at Radio City Music Hall, Mobeam was part of that. And now Mobeam is going to be in 200 million Samsung phones around the world. So that's what a good VC will do for a company. They'll make the introductions. They'll do what you can't do. And maybe they'll see, I'd say also, what we saw there was, unlike Silicon Valley where they were trying to do the technology push, we were looking at the market pull, and we enabled all of that. And so that's what we look for in terms of companies, ones where we can bring our skills to bear.
Thank you. And remember, he used the word addressable market. So let me just think about that for a minute. Let's say you've got an innovation that's a polarizing lens that can cross in front of a window and make the window opaque. The market is windows. The addressable market is the market that's making the polarizers. If your game plan is to make the chemicals and sell the chemicals, that's the addressable market. So you have to really understand what your piece of the value chain in the market is. Telling us, here's the window market, and you're really going to be the virus on the flea, on the tail, on the dog, on the gnat on the window market. You have to understand where you play in a value chain. That's not always something we understand those lingo as scientists, but it's really important. That's what the big companies can bring, and that's what angel investors bring as well. I'm going to go through another quick lightning round on another set of questions with our panel, and then ask you to ask questions. First of all, let's link it up. And Steve, I'm going to come back to you again. From an angel's perspective, what do you want as what do you think, and all of you have touched on this already, but I think it's really important. I'd like to link what you think are the key attributes you as angel investors, we as angel investors, bring to the table, and how do those attributes help to facilitate the type of exit you want. So if you can kind of help us understand the kind of exit you're looking for, they may be sitting to your two right friends, who knows, what are you looking for, and what do you think we bring to the table to help that?
Okay, so first of all, angel investors, unlike venture capital, are looking for what we call early exits. I mean, I think maybe VCs would like that as well, but they're probably more patient with a longer exit. What that means is that most of the people that I work with have a lot of gray hair. They're interested in making money for themselves, not for their grandchildren. So, they want to see a return on their investment fairly quickly. So that means exit in 3, 5, 7 years maximum. So if you come to an angel and you say, this is going to be a fantastic market, it's going to take 15 years to get there, you're probably not going to attract an angel investor. However, angels can take a look at what you're doing and say, you know what, there is actually a different market which could give us an earlier exit, and you ought to think about that. And so what angels can do, and I'm sure venture can do this as well, is help you think about the maybe an alternative market that would give you an earlier exit. Let me just say also, and this is something that I think is extremely important, an exit for an investor like an angel, it's not a monthly check from your business. We're not looking for annuities here. We're looking for a return on our principal investment. So if I write a check for $100,000 to a company, what I'm asking for is a return which would be 3, 5, maybe 10 times my investment in 3, 5, 7 years. So that means if I put $100,000 in your company, in 5 years, you're going to give me $1 million back. Right? So that's the kind of return, that's what an exit means to an angel investor. And let me just say one more thing, and that is that we ask all of our investments to our entrepreneurs to convince us that they're going to give us an exit in the proper time with the proper amount of money. And those are the kind of things we invest in. 9 times out of 10, we don't see that kind of return. However, if we get 1 out of 10, obviously it pays for all the other losers that we've invested in and lost our money on. Did I hit everything? Did I say everything that you wanted me to get on here?
I think so, because we'll get more questions from the audience as well. I think that's really important. But notice, we want a return. We care, we want to help, but we want money out the door. And I don't know about you, I do not have gray hair. I am a permanent blonde. So, Ed, since part of our dream is you, let's move on to a corporate technology scout. Since angels, when you are looking for, you've already touched about a lot of this, but what are the key attributes that as a strategic investor you want to bring to the table, and how do you want to facilitate the desired exit? And I cannot tell a lie. As a big company, help out maybe not Scott so much, but certainly help out the wonderful world of us angel investors. You might buy something for $500 million or $1 billion. That looks like M&A at that point, but it can certainly work too. So where are you on this?
Okay, well this is going to sort of echo my prior comments. So it really all is around the fit part. So for us, again, the desirable end game is a financially viable business, whether it's one that we're participating in either by owning a piece of it or owning all of it, or because it's feeding into an ecosystem for us. So, what we bring is a lot, it's big company stuff. So we have access to customers. We know how to talk to Samsung because we already sell them stuff. We already, we probably have spent more on market studies than you may have already put into your company. So we understand the markets because we already participate in them with the exception that's been brought up before. Sometimes we're trying to get into markets that don't exist, and then we're sort of all at sea. Okay, so we're betting on that. R&D and product development is something that we have in spades. So we probably have test equipment that you cannot afford. Partner with us to get access to that. We have, Dow in particular has high throughput screening equipment that really doesn't exist anywhere else on the planet. So again, as a partner, as a portfolio company, you may have access to that. Commercialization, scale up. That hasn't been specifically mentioned here, but venture capital money is the most expensive money you can get. So if you're going to put $10 million into a pilot plant using venture capital, that's a really tough nut to look at. Maybe we already have equipment where we can do that for you. So getting your products to scale, getting them into the market quickly, those are all things that we can potentially bring to the table. And they're differentiated from what, for example, a venture capital firm might bring.
Absolutely. That's a really important point. It's a really important point. Large corporations have, for some reason, and I am corporate America, okay? I admit I'm the chemical industry. We've in some ways taken a black eye recently, that we're not as innovative, that's a lie. We are just doing it in a different set of ways, and those sort of partnering opportunities are very real if it's focused in your area. So thank you for explaining that so well, because I think people don't always see that. They see us as so much like the dummy enemies, not the helpful part. And I think you've seen that too. I certainly have seen that. okay, the VC who has expensive money wants $100 million. What are your key attributes, and what do you look for then as that exit? Is it an IPO, or do you want to sell to Ed?
Yeah, it's very interesting. My first company, we actually went the corporate route. I'm an entrepreneur, really. That's my passion. So in my first company, we went the corporate route, and we partnered with a big $4 billion corporation, and it was the right thing for us. And fortunately, it was in the last analysis, it was successful. So that's certainly a wonderful route to go. Now, the downsides to doing that, though, was it was a very slow process. There's a lot of decision makers involved, and it's for anything big, it's got to go all the way up through the corporate structure. In some cases, all the way through the board of directors, and so that's a long haul. It took us 6 years to get there. And most of that was working with a big company. So VCs can make a decision quickly. They're smaller. They're more nimble. There's just a few key decision makers, and they can do that. The other thing that a VC brings to the table is the fact that they're not really limited by a specific business. For example, it's probably unlikely that Dow would have invested in a digital coupon company, even though they had all the access to Samsung and a lot of these other business, business relationships. So we're much more open to to sort of wild-haired ideas. I mean, if they're really, if we need to create a market, that's not necessarily out of the question, although that's a much heavier lift. And then the third thing I'd say is the the skills, experience, and contacts. That's really what the VC will bring to the table. I gave you the example of Mobeam. Just as an aside, one of the things you don't want from a VC firm, and some smaller firms in particular would do this, you do not want a freshly minted MBA out of a top MBA school. They're smart folks, no doubt. They've got great educations. They're probably very ambitious, but they tend not to have sort of that broader perspective, and that in general is what a young company needs. So it's the skills, experience, and contacts is the third piece.
That's great. And they're not the evil ogre. They're very expensive. I'm with Ed completely. Mm-hmm. They're very expensive. They're not cheap, but you'd like to get value for money. So your job would be to be managing them, which is not easy when they're now sitting on your board. And yes, having lived through a $50 million set of investments with a young puppy at a very large venture firm, I would like to so really help you hear what you just heard as a very wise piece of information from Scott. Careful who your VC is. We are now opening it up for you, and our faithful attendant here, Ken Polk, will help. Here's what I'd like to request. When you ask your question, if you want to please address it to a specific panelist, please do so. If not, I will take the liberty to assign it to somebody to start with and then ask for other things so we can move through as many questions as possible. I'm an ACS webinar moderator. I have been trained highly by Dave Harwell to do this fast. Bill.
I'm Bill Schwartz, and I have two questions, if you'll permit me. One is for Scott. Suppose I'm the Mobeam guy, and I have a great idea, but I don't have my first customer yet. I'm not at that stage, and you won't talk to me. I have a good idea. Where do you send somebody that may not be at the venture capital stage, say the angel investor, but what would you do?
Yeah. Steve, go talk to Steve.
The little halo over his head.
Yeah. Go find, the first sort of circle of investors is going to be your friends, yourself, and your friends and family. And then go get some good angels, people who have experience in the industry, who are, making some investments themselves, people have bring credibility with them. And then, build the first prototype and get some sales. And then, you'd be ready to talk to a VC.
Okay, you were the one with the great contacts, but
yeah.
And Steve, do you want to say something toward that? Because I think the angels, people don't realize angel networks exist. We just don't get us as well.
Right.
I didn't mean to cut you off, Scott, but I want to make
it's
sure
all
that
right.
Steve gives an answer back to this.
So angels also have great Rolodexes.
Right.
And so we can actually make a lot of connections as well. I mean, you know, it's kind of a continuum between angels and venture in that regard. Let me just say quickly, the ecosystem for funding early stage companies, which means what's the first money in your company? Well, you know what you need to do, for example, is take a second mortgage out on your home. I'm serious. The entrepreneur needs to be able to put skin in the game to get things started. And then they go out and they do what we call friends and family round. And you've got to realize that, you know, you're going to get your sister to invest in your company, and, you know, she knows that she's investing in you, and she's probably not going to get her money back, but that's, you know, that's the next stage in the fundraising. And then you go to the angels and you say, look, we've got skin in the game, we've got friends and family money, now we need the next tranche of funding that comes from angels. That might be $1 million or something like that. And then you move on to a strategic partner or to a venture capital firm.
Okay, so this is a question for Stephen. So you mentioned earlier, you mentioned this thing called a seed track deal. Can you
Right.
tell me a little bit more about that? In particular, what's the size of that market for seed track deals that you know of, and what's the size of that for chemical entrepreneurs?
Could you tell us who you are, please, and what your stage of life is, so we know who you
my
are?
name is Patrick Harney, and I'm starting a company in Kansas City.
Fantastic. Thank you.
So again, for us, a seed track deal is one where maybe 4 or 5 individual angels come together and invest maybe a total of a couple $100,000 into a startup. And one of those angels might actually participate in the company as a CEO or you know, some sort of an actual position in the company, not necessarily getting paid by the company, but actually holding a responsibility within the company. We do, at TCA, we probably do maybe 5 or 6 of those kind of deals a year. It's relatively small, but there is a real market for that kind of activity. Does that answer your question?
Okay, well, again, for your company, and then how many other companies out there would you know that would do the same?
So you're talking about angel groups. So
Just sort of for this seed track deal, like the size of the market.
So I think, for example, the Chemical Angel Network is likely
Yes, we will
does
do
that
seed
very
track
same
deals.
thing.
We will do seed track deals, and we are nationally leveraged. We're also leveraged in, as is Steve, to the Angel Capital Association, so we can help syndicate and send that information around. I have volunteered to help facilitate the Clean Tech Network for ACA, so we can syndicate deals around if needed. Your job is to find out who is an angel group locally that could actually help leverage into us, not just, so chemical angels care about you from a market perspective, as would Tech Coast angels. You also have the geography pivot point of where you are, and that combination is usually powerful.
And the other thing is that there are certain universities and in some cases economic development groups that will do the same sort of size deal.
Absolutely. Yes, and introduce yourself first, please. Right.
Ray
Thank you.
Stewart. I'm the lawyer in the house. Quick question for Scott and Ed. Financial investor, VC, strategic investor. Obviously, strategic, you have to assume you're going to have to give up control, give up the whole company. VC, maybe control, maybe minority interest. But what I want you guys to contrast is the valuation. From a valuation perspective, is the strategic investor going to give a better value to a company, or is the financial investor going to give a better value?
You mean in the dollars that we write down on the sheet, on the term sheet, or do you mean in what we bring to the deal outside of the money?
$5 million will get you 100%, or $1 million will get you 20%. What valuation-wise? There's always this debate between strategic investors versus financial investors.
Well, I mean, I'll give you my candid perspective, having been on both sides. I think a strategic partner will almost always give you a better deal, and there's lots of reasons for that. Mm-hmm. You know, there are many reasons why a strategic. Maybe Ed can speak this better, but there's many reasons why a strategic will invest. And it's not necessarily just about that upfront money, whereas, a VC, it is.
I can't speak to that directly, not having enough data on which to base a determination, but what I will say is we very often co-invest with venture capital firms, in which case I don't think there's going to be a significant difference because we're both in the same deal.
Yeah, ditto to that.
That's an important point. It's the question of a term sheet. Do you understand? I don't know if all of you in the audience realize what he's talking about. It's if there's a valuation on the table and somebody's already invested in that valuation, the other one's going to follow on at that same round. So it's been set already by someone, and somebody's going to follow that in the game. Angels will do the same thing. If his angel group started out with a term sheet and he's looking to syndicate, we're not going to negotiate another set of terms. We're going to come in at the same terms as another angel group. So for some of the younger people in the audience, I just want to make sure they hear the words. Please.
I should just add one comment. And I say that not that strategics won't drive a hard bargain, because they will. Yeah, I just want to add that caveat.
He was giving you too much credit there.
Yes,
he was getting upset.
You're being defensive.
My name is Anil, and I'm an entrepreneur. So I have a bit of a controversial question, and I hope it doesn't cause too much controversy. So this question is for Scott and Steve.
We love them.
So what you mentioned that your success rate of getting a successful company is 10%. Okay, that means 9 out of 10 companies fail, and that one company hopefully makes enough for you, for the company or for you. If with that kind of failure rate, I mean, if there were cars in the market that 90% of the products fail, that would be a terrible car company. So what gives? I mean, what makes you successful? Is that some of the rules that you're following just meant to be financially profitable rather than number profitable?
Okay, so let me add a little bit of granularity to that. So let's say out of 10 deals, maybe 2 of them actually, the companies actually go away, you lose all your money. Maybe 5 of them, the companies continue, and they're maybe break even, maybe a little positive revenue, and they go on, and they might be Walking Dead type investments. You can't get your money out, there's et cetera, but so they're still alive. And then maybe 1 or 2 actually exit in the right time frame, but you get maybe 2x return on your investment. And then 1 actually does very well and IPOs, and you get your you get your 10x or your 100x or whatever it is that you're looking for. So that's kind of the way it traditionally works. Now I've talked to some venture firms, and they say that if you get 1 in 15 that really does very well, that pays all the bills basically. So it's a difficult situation to try to explain to people, but that's the kind of sort of background experience that we've had, and that's what we look for. Mm-hmm. Does that answer?
No, I'm just questioning why. Is that because we don't know the market essentially is unpredictable, or is there some other reason for that?
Yeah.
Yeah, well, it's like going to Las Vegas. I mean, it's very risky. It's risky investment. We invest our own money, and the money that we invest is money that we don't need to live on. So it's okay. If you lose it, you're still going to be able to pay the bills and so forth. So there are other reasons for doing it. Being involved with an entrepreneur is a very positive thing for many of us. So I don't know. Maybe you can add more to that.
I would just add to that, there's some very good academic research which shows why startups fail, and they fall into a couple of big categories. Interestingly, my recollection is that technical failure is only about a quarter of the reason of why a company fails. So it's really usually not about the technology itself. And the other thing I would say is that one of the things that is a badge of honor, and at least on the West Coast, is that if you've been in a failure, I mean, it shows that you've been through it. You've been through the process. Hopefully, you've learned from it, and the next go around, the probabilities of being successful are a lot higher.
If I could throw something in there, I think what they're both saying is if you just take a step back. Do all of you have many of you have a financial planner, right? You take your portfolio and you talk to them and you say, here's my tolerance for risk. Here's what I'm looking for as a return. I happen to be a very conservative investor at my age. My husband is 14 years my senior, so I'm a very conservative investor. My portfolio has a balance of bonds, stocks, etc. that looks a certain way, except for the money I'm allowed to play with as an angel investor, which is the whoops, off the scale part. So as an angel investor or as a VC, it is that portfolio look of a risk management. Just as a head of global R&D for major companies, I had a risk portfolio of all the projects I ran to tell the board and the stock analysts about why I was going to give them a return. In the end, you are managing across multiple risks. There's science, there's market, there's human, there's global economic, and what you're trying to do is mitigate that risk by building a portfolio, and you don't always do it as well as you'd like to do it. VCs took a hit in the last 10 years. The returns look like garbage, and the bigger the VC, the worse, because it's like a $20 billion company. You got to make a 10% return. That's one heck of a bogey versus 100 grand for some of us. So no, it is not tolerable. And limited partners are slapping VCs, and it's harder to raise funds for some people for that reason. So we are looking, and that I would like to argue is why we are pushing more for some of the things we said before. Understand who your investors are, understand who we are, understand what you're expecting to return, because our questions are going to be harder for exactly those reasons. It's a great question. It's a very fair one. Sorry.
Hi, my name is John Williams. I'm a former professor of chemistry at Temple University. I and a colleague at the university have invented a drug called fluorasterone. Fluorasterone prevents or protects you or reduces the incidence of cancer, obesity, diabetes, pulmonary hypertension, and a whole series of other molecules. It's really a disruptive invention, I think. We're looking for about $5 million in order to do clinical trials. We've got excellent animal data. It was originally given as an oral administration, and unfortunately, first passage through the liver metabolizes the material. Now we find that we can apply it topically. We have a patent that will issue at the end of this month, and we have applied for other patents on the thing. And my best plan of going through a venture capital group rather than VCs because they don't have enough money.
So I'm sorry, you said a venture capital...
About $5 million.
No. You said a venture capital group versus VCs. They're the same. Help us, please.
Rather than angels, I'm sorry.
Rather than angels.
Yeah. Right.
Oh, that's good. So Steve, you want to start with that?
Okay, so actually I spoke with you last night about this. It's a very interesting opportunity. Angels don't do drugs. You heard that before. So generally speaking, angel investors do not invest in drug discovery companies. However, this is not a drug discovery company. This is a drug development company. Right. This compound has already been in man, as I understand it. So there are opportunities for companies like that angels could invest in, because it's conceivable that the company could achieve a milestone and have an uptick in valuation and therefore an exit in something like 3, 5, 7 years. So it does fit. The problem is that you're looking for $5 million, which, as you know, is more than an angel network like TCA will come up with. So that, in my mind, would be more of a venture type investment. However, if you tranched your money, in other words, came to the angel group and say, look, I need $1 million today, and we're going to hit these milestones, and when we hit these milestones, we're going to do a second round that's going to be maybe $3 million or something, that might be a way to get into an angel group.
Yeah.
Scott, do you think? Yeah.
The only other comment is, when you go to look for venture money, look for a firm that either specializes in that or has a group that really knows your particular market. The other thing, I don't know anything about your company, but and what point you are, you want to make sure you have a good CEO, somebody who's got experience in, preferably in the specific disease market that you're interested in. You mentioned a whole range of things. That's a bad thing to talk about usually. You got to decide which you're going to focus on, and then really, You've
already done that.
Yeah.
You read number 4 over here. I've got it all outlined.
Excellent. Yeah, and that's what you need to do.
Because that gives you an opportunity for focusing on a strategic. It might not be Dow at the moment, but it could be someone, and that's the whole point. I'm going to call an end to questions now because I would like to have summary comments from each of our speakers. And Scott, I'm going to pick on you from that side. We always believe that here's the last thing They're going to leave you with a main message that you remember, and you can hit them up later. Here's the main message they're going to leave you with to remember. So here you go.
Well, I guess I would just say, my hat is off to all of you. If you have the, wherewithal and the courage to step in and go for this, I can't say enough great things about what you're doing. Just go for it and stick with it. I mean, it's the great American dream, and there's ways to make it happen if you're passionate enough about what it is you want to do.
But yeah, to some extent, echoing Scott's remarks. I mean, we, as Pat mentioned, I think all the big companies now realize that we have to look outside for the disruptive innovation, and we need to find ways to foster that, to help you do it. And ultimately, we would like to in some way participate in that. So I guess that, and then just try to crystallize in your mind the difference between the different kinds of investors, what they're looking for, what they bring to you, and then you really have to ask yourself, and what do I need at this stage in the development of my company, and which one makes the most sense for me, because it's not just about the money.
So I guess what I want to say is that if you're really passionate about the technology that you have or the company that you're going to form and lead, be smart about what you're doing. Think about what's your plan for funding. You need to have a funding plan. You need to have a regulatory plan if you're in healthcare. You need to have a marketing plan. You need to have all these plans. And you can sit and do that at your breakfast table. You don't need funding to do those plans. Your plans may not be right, but at least if you have a plan, the investor eventually will see those and will see how you think. Don't underestimate what your own resources are. So like I said earlier, take out credit cards, take a mortgage on your home. There are lots of ways to come up with early stage cash that's quote unquote non-dilutive. A lot of people think that they need money to get started. That's not true. You have resources. You can do a lot of this on your own. The first thing you do is you don't go out and rent office space and print business cards. That's not the first thing you do. The first thing you do is you sit at your kitchen table and you think about the plan, your funding plan, and how to get started. And then you come to dilutive capital like angel investors, venture capital, or strategic partners, and sort of do that in a stepwise fashion. So plan what you're going to do and talk to somebody like one of us and with your plan and see if that makes sense.
And I'll just take the prerogative to say one thing on top. You've heard them say it time and time again, implicitly, I'll say it explicitly. The team matters. Scott mentioned, if you need a CEO, get a CEO. Ed said, we can bring it, if not, we'll help you. Steve said, sometimes we as angels can come in. Do not be embarrassed that as a scientist, you're brilliant at what you do, or an engineer, I don't mean to eschew my engineering colleagues, that you're brilliant at what you do and that you don't also need the help of a marketing person. If you don't have the vocabulary and the lens of the market in your pocket, if you need to understand the value chain, the market, talk to people. If you think Dow can help you, shout them up at an ACS meeting. That's what ACS meetings are for, because it's the team that will matter in the end, and don't be embarrassed if you don't know it all yourself. It's not invented here, doesn't help anybody. And as scientists, sometimes we could use, you don't hand the keys to the kingdom over to that business person, but what you do is have a right team, and that's really important. Thank you very much, panelists.